I welcome everyone to another episode of Let's Talk Special Economic Zones. I'm your host, Ainsley Brown. And in today's episode, we are going to explore tax reforms, particularly the OECD's Pillar 2 tax reform, or OECD G20 Inclusive Framework, base erosion and profit shifted. It's a lot of words there, but it's a very important topic. Specifically, I want to explore what are the options for special economic zones, and this is a particular topic of importance for um, developing countries, particularly, I would say, um, most special economic zones, particularly if they offer reduced corporate income tax, fall within the scope of this global tax reform. Um, and it's a very historic tax reform, in fact, and it's supposed to kick in by 2023, and we're on the cusp of that right now. We're in November of 2022. Um, Although there has been some slowing of the implementation. For example, the EU had a critical vote, I think, in April, and Hungary, one of its members, voted against, or so it slowed, for example, the implementation. However, individual members have said that they're going to go ahead, and importantly, like France and Germany said they're going to go ahead and implement this. And it's important for this to note that the inclusive framework, and particular Pillar 2, covers about 95% of the um, FDI stock, according to the UNCTAD's latest investment report, which is the World Investment Report, International Tax Reform, and Sustainable Investment. I'm going to refer to that a lot because there's a lot of insights that can be gleaned from that very important paper. It prefaces that, these reforms are something that nobody can ignore, and I agree. However, there's some nuance there that we need to explore, because what are the real options on the table, practically, on the table for developing countries in particular? And we'll get into that. And so, what, in essence, they're trying to do is to impose put a floor on the lowest level that corporate income tax can go. And what they've come up with is a 15% corporate income tax rate. Now, how it's supposed to work is that it's not that people will impose and say you must have it. What they've done is they've done what's called the common approach, which is basically allowing countries to voluntarily implement. However, there's a catch. If you don't, a country has the right to do a top up. So if country A is the source country from which the FDI came from, and their company incorporates a subsidiary in country B, country A has a corporate income tax rate of, let's say, 20%. Okay. And then, which is above the threshold of 15%. And say country B has a corporate income tax rate of 10%. So it's below the threshold of 15% by 5%, right? So country A is then allowed to do a top up of 5% from the profits coming from country B, that the company from country A incorporated a subsidiary in country B. A little confused there, but you get the point. Now, um, that little top up, makes the difference. So it's not saying that country B needs to change their income tax rate from 10% to 15%. It's just saying that if you leave it there, other countries are allowed to do a top up. Now, importantly, and this is where the rubber meets the road. So you may say, what are the options? Based on the example, the options become clear or should become clear by now. For country B, let's focus on country B. That's country B because country B is the typical position of developing countries, right? Lower tax rate to attract. And I should also say that while what's called Pillar 2, or the globe, which is, let me make sure I get the name fully correct, that's the Anti-Global Base Erosion, or Globe Pillar 2, of the OECD / G20. Now, it doesn't just apply to corporate income tax. It looks at the effective rate, right? So it is really looking at, did you put in some other things in there that can even lower it further from the 10%, as we discussed, down to maybe 6 or 5%, and such and so forth. So it's very complex. There's a formula that they use. I won't get into that, but point is that they look at the effective tax rate. Now, let's get into what are the options. So one, for country B. Country B can do nothing. Keep its rate at 10%, right? You may say that's not a viable option, but it may just be. Let's take a look. Option 2 is lower its rate, or increase its rate, I should say, to 15%, right? Is that a viable option? Does that make sense? It may not in all instances. Now, why do I say this? The important caveat is that the Pillar 2 only applies to certain entities. There's a handful of entities or handful of industries that are excluded. One prominent one is shipping, for example. So I'm not referring to that. The important caveat is that it only applies to companies that have a global consolidated revenue of 750 million euros. So massive companies that operate globally, that 750 million euros of revenues collectively. So if you have subsidiaries in A, B, C, D, and E countries, and your revenues come up to over 750, then it applies to you. Now, why I'm saying what I'm saying in terms of the viability of these option A, option B, is this. And I'm not here to really give advice. I'm doing this so that it's thought through. Now, if you are targeting FDI of companies that do not meet that threshold, again, the second option becomes very much viable. That is to move, or let me see if I get this right. I just confused myself, so I had to pause. When you look at it, let me explain this way. So if country B has its rate at 10%, it's a small open economy, and it does not attract the massive players, the big FDI, right? It doesn't. Or maybe it does, but it attracts them in commodities, mining, which is also an exempt industry. So those are out. So it doesn't really need to do anything, right? Because its main source of FDI is well below or below that threshold. So the top up does not apply to it. It would never apply to it because the FDI. However, if country B says, you know what, I want to be in line. I want to ensure that I'm following global best practice. Let me move my rate from 10% to 15%, right? Let me move it. But its competitors, who are all of which are going after companies that are below that threshold of 750 million euros in global accumulated revenue, says, no, I'm keeping my rate at the 10% or 8% or whatever my rate is, country C. Now, country B now would have basically priced itself out in terms of a fiscal incentive being attractive to, especially if it is the main thing that they're using as a fiscal incentive to drive FDI to them. So they would have priced themselves out of the market by moving from that 10% to 15% because the threshold of the investments do not the type of investment, type of companies that they're going after do not meet that threshold. So policymakers will have to really examine, right, what's the viable option. However, I will also put it to you this way. It does also put a cap on your investment or what you're going after because let's just say you decide to upgrade. You are, moving higher up into value chains and you're starting to move into things like design, not just manufacturing, but the design of things. And there's more knowledge-based companies that you're going after, a knowledge-based FDI that you're going after. If country B does not respond and move up its rate from 10 to 15%, it could be put in a cap, right? It could be put in a cap in that um, you will always be chasing everything that's below because you'll be subjected to that top up. And if countries are okay with that, and in some instances that is okay, that means you're never going to land um, one of the big players because you know that you're going to have to put that tax in place or subject to the top up, which again, whatever option suits you may say, hey, it doesn't matter, right? However, that's revenues that are leaving the country that you could have collected, right? Because you have now gone after some bigger players or a bigger player. So there has to be a balancing. So it's not just a case of, as I said, option one, which is to move up do the fifth from 10 to 15, whatever, or whatever your base is, increase the CIT, corporate income tax rate, or option B, do nothing. There's much more nuance to it than that because each one has a consequence depending on where you are in terms of the type of FDI that you are seeking to attract and actually do attract, right? So there are these options must be looked at, I would say, carefully before any action is taken. So kind of went a little bit long today, but if you like this episode, please like, share, and subscribe. If you want to see me do a particular episode or you want to leave a comment or have a question for me, just leave a comment down below and I'll get right back to you.